Gotcha. Hello, everyone. This is Sean Gibson with Mobile Mailbox Money. And today we have the president and CEO of Mobile Mailbox Money, Silvercrest Opportunity Fund, and Win Mobile Homes. Is that right?
President of Win Mobile Homes.
Woo!
Partner in Mobile Mailbox Money, president of Silvercrest Opportunity Fund. Happy to be here today at the Cigar Lounge, Fox Cigar Lounge, smoking a Camacho.
That's a lot of hats, a lot of cigars. So thanks so much for sitting down and talking with me. I want to have a brief conversation. For me, a lot of people don't know, but I've been in real estate a long time. But the method, the model that Alvin's putting in, he has right now is unbelievable. He's in a section of real estate investors most investors do not understand or not even aware of. Most of your investors, they'll fix and flip, they'll get rentals, they'll do all these Airbnb, little apartments, they'll do land development. But that takes so much expertise, so much capital, and there's a lot of risk. So at the end of the day, there's definitely some opportunities in other industries. But what I'm really keying up on today is two of all those companies that I understand the most. One is Win Mobile Homes. First, we'll start with that. What is Win Mobile Homes for the people who don't know?
So Win Mobile Homes, we started as an investment company buying and selling manufactured housing as a fix and flip program. And operating as a licensed dealer of manufactured housing, license 8670 here in Arizona, have cultivated a brand and awareness to where now we're one of the largest third-party manufactured home dealers here in the Valley. Buying and selling, buy, sell, trade, list, and invest in manufactured housing, personal property on leased land. Not a lot of people operate in leased land, personal property, manufactured housing. That's our specialty.
Perfect. So I drive these mobile home parks all the time, and I see your guys' signs. Every mobile home park I go into, buy with Win Mobile Homes, sell with Win Mobile Homes. How did you guys kind of corner the market here in Phoenix, Arizona?
So, we started just driving parks like Sean, looking at for sale by owners and cultivating a listing strategy and knowledge of financing on manufactured housing. So people started coming to us because they knew that we could convert where the alternative was listing with an agent, and they didn't know how to finance a manufactured home. Not only that, we have our properties that we buy, rehab, resell, and cultivated a seller finance program. So our knowledge of financing really started to step out, I think, to the end users that owned manufactured housing here in the Valley, as well as people looking to buy. Because they knew they could come to us and we could actually convert, where the alternative was listing with an agent who was non-knowledgeable of personal property transactions, MBD titles, who will finance a manufactured home on leased land. So cultivating that knowledge, people started to flock to us ultimately to either list the property for sale as a brokerage under the Department of Housing, or give them a cash offer. On top of that, our institutional relationships of the management and individuals operating these mobile home parks have come to favor us because of our niche market expertise in manufactured housing. So it's been a blessing, to say the least. Our knowledge in the transaction base really started to have people gravitate towards us.
Gotcha.
Opposed to us having to beg for people's business. Now they understand a viable source of someone to transact a manufactured home, whether it be finance or cash, knowing that it'll get handled correctly. Title transactions are different than residential property. So building that brand and awareness, people have to come to us to either list the property for sale, a cash offer, or want to buy a home via seller carry finance or through a third party, or even a cash offer. So that's kind of how we cultivated our relationships with the parks, them knowing us and being licensed, bonded, and insured, as well as people understanding our expertise in the finance component really starts to have people understand and better have confidence to go with us as a business, whether it be listing or seller finance or whatever it may be.
Okay, gotcha. So the next company that you own is called Mobile Mailbox Money. So for those of you who don't know what that is, I know there's a mailbox and there's money, which I like, But what is that? What kind of company is that actually?
So as we seller finance transactions in the Valley, we look for private investors that want to participate in cash flow programs outside landlord and tenant complications, where, in other words, opposed to a rental strategy, we buy this home, rehab it, resell it via seller carry finance, underwrite a borrower, and sell that at a yield and interest rate of 14% for a 20-year term, providing an investor the availability to buy that loan that's an underwritten, qualified, and cash flowing opportunity outside landlord and tenant complications. That's mobile mailbox money, creating mobile home mailbox money out and being the bank.
Sure.
You know, in a cash flowing position, you have your collateralized lending opportunity at a double-digit yield, depending on if someone wants a 1-year term or 20. You know, those are all opportunities for someone to earn a passive rate of return, and mobile mailbox money is what cultivated out of that strategy. With One Mobile Homes, who seller finances 5 transactions a month, and we sell that loan on mobilemailboxmoney.com. So you can go to Mobile Mailbox Money and buy a loan today and start cash flowing in as little as a 30-day program, emulating a Warren Buffett investment strategy. So as we come to realize in real estate and, you know, any other investment opportunity, you end up running out of money if you find a great opportunity.
Right.
So you start to include individuals around wanting to get a smashing passive return with the opportunities that we have on the table. So that's mobile mailbox.
Okay, so the third company you own, I don't know how you sleep at night because you're so busy. The third company is the big boy, is Silvercrest Opportunity Fund. Now, I know it's a fund, but tell everyone, what kind of fund is it?
So Silvercrest is a 506c accredited investment fund, Reg D under the SEC. Operating compliant, offering accredited investors a 10% return for a 1-year term or 12% net for 3 in an income-oriented investment strategy, investing like Warren Buffett. In other terms, it's a debt program where we bank on first lien performing debt on the homes that we seller finance. So, you know, double underwritten clients, seller financing at 14 and 15%, and I offer per unit owner share in my portfolio of notes that we hold in Silvercrest Opportunity Fund at negotiated rate. Those net fees are transparent. We bill our management fees on top. So upon your revision of the private placement memorandum and the deal disclosure for either the 1-year or the 3-year, we can help you start earning in as little as a 30-day program in debt. Performing debt, outside of fluctuations in the stock market, outside of problems and hardships in operational long-term rental strategies. You know, this is being the bank in performing assets at an above average return and, you know, safe, stable, quality assets to deserving borrowers. Here in one of the hottest markets in the country, Arizona.
Right.
And I think it's truly needed now more than ever because of hardships and interest rates, high pricing in residential property.
Yes.
You know, and if you think property is going to fall 50%, I think you're sorely mistaken. You know, nationally, institutions are going to own 30% of single family by 2030. They may already have.
Right.
And then multifamily seeing bloodshed because of fluctuations in interest rates. You know, where's the alternative for a high net worth investor to participate in an income-oriented investment strategy and not lose their capital? You know, I think me and Sean have talked to multiple capital investors, and they've lost tremendous amounts of money.
Absolutely.
Indications on multifamily specifically, and cash flows dried up on single family, Airbnb saturated.
Yep.
You know, in our local market, you know, may work in some other case specific environments. But in manufactured housing, and to think that no one's investing in manufactured housing, Warren Buffett's the biggest player in hedged investments in the nation, in the world. You know, Berkshire Hathaway, Yes Mortgage, Yes Communities, 21st Mortgage, Clayton and Cadco, all investments in manufactured housing. Well, what does that tell you? You know, the investor maybe watching here today, that there's other savvy high net worth investors hedging in manufactured housing. So to say that nobody's investing in this asset class and to not see the value, you may be missing out on an opportunity, a golden nugget of opportunity. When something's highly undervalued and misunderstood, well, what is that? That's the pot of gold at the end of the rainbow.
Always.
Understand how to navigate a transaction like that and build velocity in an asset class where we see a crazy amount of deal flow and opportunity, with not much competition. Anyway, that's silver
Yes.
opportunity.
All right. So yesterday I put an ad on Facebook and I put all the information in there, and I had people want to ask 4 questions to him. So I'm going to ask a couple questions if you don't mind, right? So I explained to them the process, and they went, so Alden, this is Jeff C. I'm a real estate investor here in Phoenix. I get your concept. Why don't I just buy a manufactured home myself, fix it up, and sell using my own capital since I already have cash? Why would I go through Win Mobile Homes or Mailbox money?
So the difference is sweat equity and a passive rate of return. It's all fun and games when you go buy an asset and try to flip it. There may be more construction costs associated towards the rehab of that property than you didn't originally anticipate. Manufactured housing is case specific. If you don't know how to operate, it makes it lightly a challenge, especially with the communities that own mobile home parks here in the Valley. And that's a fix and flip strategy. Long story short, on manufactured housing, if you're a doctor, a lawyer, a dentist, anyone of high net worth making great money, you don't have time to go buy a property and flip it at the end of the day. This is not for the fix and flipper who wants a 20 to 30% margin on their flip and is okay with that risk out in the market. Not everyone has the advantages of connections and general contractors, electricians, roofing repairs. That's a separate conversation, and we could possibly help that individual buy a home if they want and fix and flip it. But the opportunity here, more focused on, is a passive rate of return, is for an investor that wants to buy a rental and have no complications with landlord and tenant operational hardship of, maintenance, management, taxes, insurance. You're the bank. You buy a cash flowing note, and this is something we put a bow on. To find an opportunity like this out in the market is virtually non-existent. For someone to buy a cash flowing position that we already did all the work of buying it, flipping, rehabbing it, and providing a double-digit interest rate on that transaction. So 2 definitely different strategies. I would rather spend time with my family and travel and make a double-digit contractually agreed upon return. That's where we're going at the end of the day.
Okay.
Passive investment.
Thanks so much. Next question is from Craig C. Craig said, hey, Alden, your program on Mailbox Money is fantastic. My brother actually bought a note, but his note holder, they stopped paying. He had to fly to Florida, do the eviction, get him out, paint, carpet, everything, the whole turn. What do you guys do if the consumer stops paying in Arizona?
Yeah, great question. If you buy a note in its entirety out of our portfolio, we haven't done deals in Florida, but if that guy needs help, happy to provide some insight. In manufactured housing, a repossession takes about 40 days, and you get title back after non-payment. So within 2 weeks of non-payment, they get to pay or quit, and then 2 weeks after that, they get a eviction notice. 2 weeks after that, we've now retitled and get a writ of restitution. So ultimately, retitle the property and perform that asset at no cost to the investor. If they buy a note from us, hypothecated, which means to pledge an asset in order to garnish capital investment, we reperform the home on non-performance. If someone buys a whole note within their portfolio and they buy it from us, at cost, we'll provide them our back office fees in order to reperform the home. Well, what is that? That's like $700 eviction to the attorney. That's maybe, a small paint and interior flooring rehab due to our contractors. And that's under market expected. You go call any attorney and contractor, they're going to charge through the roof. We get like quotes at $1 a square foot for flooring, and same thing for paint. So just some rough cost estimate, and then they resell the property. They'll get our agents at our cost, which is $4,000. We quote 8 to outside listings, and then help them ultimately find a buyer niche market in manufactured housing. Very case unique in comparison to residential transactions, where you have 3 months of non-payment, and then after that 3 months they have a cure period. 6 months you go into foreclosure, and then I think the cure period's after that. So it could be like 8 months by the time you repossess a unit at the end of the day. So definitely important to identify the differences in residential transactions and manufactured housing. So through the fund, third option is fully passive. So we reperform the asset at no cost to the investor. So if you buy a whole note, you get it at cost. You buy hypothecated at no cost to the investor, and same thing through the fund.
All right. Thanks so much. Question number 3 is from Adam Z. So Adam Z says, "Oh, this is great. I'm a fix and flipper here in Phoenix, Arizona. But what happens if I invest with you guys and the project goes over budget? All of a sudden, you got to redo you want to do granite or add cabinets. Every fix and flip I've always done, it's always gone over. How do you guys not go over on your budget costs? If I were to invest with you."
Yeah, great question. Going over budget is a consistent concern for a lot of fix and flippers if they sub out their contractors. 9 times out of 10, we're using our in-house 1099 individuals. We have about 10 to 15 rehabbers in our full-time repertoire. If it does end up going over originally anticipated, which is easy to do, you could over rehab a property pretty quickly, especially with concerns of tariffs and things of that nature, of prices increasing. That's no cost to the investor. We take that on the chin. That was priced into our available exit at the end of the day, and we're pricing our acquisitions in order to satisfy enough margin that if a 20% problem came into equation, we're still making healthy profit given how we acquired the property and time frame of the exit. At any given time, we're netting like 30-40% on a property, and some even higher, depending on the area of the home, how much rehab it needed. And at the end of the day, we're kind of backtracking on how much rehab we're associating on certain units, depending on the area. But long story short, the investor doesn't feel that burden. Okay. Why? Because they're a passive investor. They're a debt partner. They're not on the equity or upside of that purchase and exit. They're making a double-digit interest rate as a bank.
Yeah.
Essentially, at no exposure to market volatility. Really, we're taking on that brunt and that potential risk out in the market to fix and flip a property, and our equity cushion on every property is normally pretty healthy, providing great confidence for an investor to participate at any given time.
Okay, excellent. Appreciate that. Question number 4. So this is from Amy C., investor here in Phoenix. So she said she's got 6 Airbnbs and they're currently all vacant. How do you guys handle a vacancy on Win Mobile Homes or Mobile Mailbox money? What happens if it doesn't sell? What do you guys do? Because she said that she's stopped.
Yeah, so Airbnbs historically here in the Valley ever since the Super Bowl have been struggling. I heard a story of one of the largest Airbnb door owners in the Valley, and he had half of his portfolio vacant during the Super Bowl, which was supposed to be a huge hit for a lot of people. And that was back in 2020, 5 years ago. So, I'm not surprised that the Airbnb market, vacancy and interest in people buying manufactured housing is not so much equated to a residential appetite. Why? Because residential real estate here in the Valley is $450,000. Right. And the average hardworking Arizonan can't even afford to qualify for a residential purchase. And they're not going on the weekends to spend in Airbnb. Yes. the people in Airbnb are really starting to go to hotels more than not because of increased fees, the cleaning fees, and things of that nature. You know, so Airbnb has gotten kind of a sour taste in the end consumer's mouth over the past couple years. You know, we've seen some price adjustments here in the past year as uncertainty has taken place. But really, for me, in manufactured housing, you know, affordable housing is in a state of emergency here in Arizona, but also nationwide. And if we can match or beat market rent and ownership of a manufactured home, that's where we start to see traction. And as someone in an Airbnb model, you know, that was banking on appreciation and a rental income, you know, it's in comparison, if she were to own 6 notes, really, if she owns 5 Airbnbs, that's $1 million at least. That could be $2 million more likely than not. If she owned $2 million of manufactured home notes, that's at $50,000 a piece. You know, that's like 20 notes or something like that.
Absolutely.
You know, at 20 notes and a 2% default rate, you know, how much money is she collecting in adjacence to an Airbnb strategy with an underwriting process that's not seen in Airbnb. Airbnb, you can go rent a house if you got the money.
Right.
But in manufactured housing and these loans, they have to qualify. They have to qualify with credit, debt to income ratios, you know, verifiable income. So I'd encourage her to probably sell her Airbnb and buy manufactured home notes. Why? Because people are going to affordable housing. If residential real estate is highly unaffordable, where do people go? Affordable housing.
Yeah, that's it.
If people are losing their shirt and going and trying to downsize like people are doing now, you know, where are they going to go? Affordable housing at the end of the day. You know, we have some hardship in selling certain properties in different communities. We have a pretty good breadth across the valley from Mesa, Tempe, Phoenix, and Glendale to hedge across the desirability of the market. And some homes sell better than others. Some homes we break even, you know, at the end of the day after commissions and things of that nature. But we hedge on the note. You know, it's not made in so much the fix and flip. You know, that's a lot of the primary of the business. You know, those profits are healthy at any given time. But even if we were to sell at a net even or even a small lot, we're picking that up in the note itself.
Okay. So if you don't mind, if you have time for one more question, this is from our guy Adam Z. So he said, all this sounds great. Everything's going well. You bought the manufactured home, you fixed it up, you found a buyer. I'm getting my checks every single month, and the manufactured home burns down. Then what happens?
Great question. So,
good question, buddy. Yeah.
There was a physical asset there, and the asset was required to be insured, not only by the note in the mortgage, the seller finance transaction, but also the community. The parking requires an insurance policy, and sometimes more than what the house is even worth, in order for replacement and demolition and things of that nature. I hear as little as $100,000. You know, they're requiring an insurance policy. It's required for the loan. So in other words, you're insured. You're listed on the policy. If it does end up burning down, it was insured. We get notification if that insurer goes non-insured and they stop paying their insurance, we get force-placed insurance. So, you know, in layman's terms, there's a company there that'll pay us if that house burns down.
Excellent. Well, that's all the time we have. We're going to get back to cigars, but this is Alder Guajardo. I'll let him sign off.
Yeah, if you want to buy a note today, buy a note at mobilemailboxmoney.com or invest with Silvercrest Opportunity Fund. If you know someone wanting to buy a home here in the Valley and doesn't qualify for average purchase prices, qualifies for a rental or an auto loan, they may qualify for ownership in a manufactured home with winmobilehomes.com. Appreciate you viewing today. Like, comment, follow, and subscribe. Join our masterminds every week on Thursday. Investing like Warren Buffett.
Sounds good. You know what? I actually want